All right, welcome back. With all the meme stocks, the crypto craziness, and just general market chaos out there, it is so easy to feel completely lost. But what if I told you the best guide for navigating today's wild markets was actually written decades ago? Let's dive into the absolute genius of Benjamin Graham's masterpiece, The Intelligent Investor. So let's just start with the biggest question, the one you have to ask yourself. When you're sitting there, finger hovering over the buy button, are you actually investing? Or are you just rolling the dice at a casino? Because honestly, in today's world, that line has gotten so blurry, it's almost invisible. And figuring out which side you're on, well, that's step one to getting a grip. So here's our game plan, straight from Graham's playbook. We're going to nail down the crucial difference between investing and speculating. Then we'll introduce you to the infamous Mr. Market. We'll figure out which type of investor you are, learn a way to find a stock's real value, and wrap it all up with the ultimate secret weapon, your margin of safety. Okay, first things first. We have to draw a hard line in the sand. See, Graham was worried, really worried, that Wall Street had basically hijacked the word investor. They started slapping that label on anyone who bought or sold a stock. And he knew that was a dangerous, mischievous game that sets people up for disaster. Here's the difference in a nutshell. An investment, that's a business decision. You're doing real analysis, you're making sure you don't lose your shirt, and you're aiming for a solid, decent return. Speculation, that's just gambling on which way the price will wiggle. It's all about trying to time the market, chasing those huge fast profits, and staring at the stock ticker instead of the business itself. This right here, this is the golden rule. It's Graham's North Star. For something to be a real investment, it needs three things, non-negotiable. 1, thorough analysis. 2, safety of your principal. And 3, an adequate return. If you're missing even one of those pillars, you're not investing. You are, by definition, speculating. Period. So, to help us tune out all that speculative noise, Graham gave us one of the greatest stories in all of finance. It's an allegory about your totally unhinged business partner, a guy named Mr. Market. So, get this guy in your head. Every single day, he shows up at your door yelling prices at you. One day, he's on top of the world, totally euphoric, convinced your business is the next big thing, and offering you an insane price for your shares. The very next day, he's a mess, completely depressed, positive the sky is falling, and begging you to buy his shares for practically nothing. This guy is the stock market's mood swings in human form. Now, Mr. Market is both a huge danger and an incredible opportunity. The danger is obvious. You let his crazy emotions infect yours. If he panics and you panic right along with him, you've already lost. But, and this is key, his irrationality is also your single greatest advantage. Especially today, with high-frequency trading, where his mood swings happen in microseconds. The intelligent investor just ignores his daily drama, but is more than happy to buy when he's terrified and selling everything on sale, and then sell it back to him when he's giddy and overpaying. Okay, so if you're going to deal with a guy like Mr. Market, you can't just wing it. You need a strategy. And Graham says there are really only two types of intelligent investors. You have to figure out which one you are. Are you defensive or are you enterprising? The defensive investor, you could also call them the passive investor, is all about two things, safety and simplicity. They want to avoid big mistakes and earn a decent return without a lot of stress. The enterprising or active investor, that's a different breed. They're willing to roll up their sleeves, put in the hard work, and do the research to get better than average results. They treat it like a business. And you really have to choose a lane. And here's where we've got to be brutally honest with ourselves. So many people today are following this kind of trader's blueprint, thinking they're being super enterprising. But just look at this list. Are you really just timing the market? Are you chasing after every hot tip? Using borrowed money? If any of this sounds familiar, Graham's warning is crystal clear. You're not being an enterprising investor. You're just a speculator in disguise. And you're playing with fire. So how on earth does an intelligent investor actually see through all of Mr. Market's nonsense? Well, you need a tool to find a company's intrinsic value. Think of it like getting a pair of X-ray goggles that let you see what a business is actually worth, no matter what silly price the market is shouting about that day. Now, Graham gave us a pretty famous formula to get a ballpark estimate of this value. And I know it looks a little scary, like something from a math textbook. But don't worry, it's really just a simple, structured way to ground your decisions in reality, not in market hype. Let's just break it down real quick. V is the value we're looking for. You start with EPS, the company's real current earnings per share. Then you multiply that by 8.5. That was Graham's baseline number for a stable company that isn't growing. And finally, you add 2 times G, which is your best guess for the company's growth rate over the next decade or so.
Look, I know what you're thinking. The math is from 1949, and yeah, you can argue all day about whether 8.5 is the right number now, but you'd be totally missing the point. The principle behind this formula is as true today as it ever was, and it is timeless. You have to value a business based on what it's earning now and a reasonable expectation of growth. It's a system to stop you from overpaying for pure hype.
And that brings us to the final piece of the puzzle, the big one, what Graham called the central concept of investment. This is your ultimate shield, the armor that protects you from the market, from bad luck, and honestly, from yourself. This is the margin of safety. To put it simply, the margin of safety is just the gap between what you think a company is worth and the price you actually pay for it. The goal here isn't to be a perfect fortune teller. It's to build yourself a cushion, a buffer, so that if you're a little wrong in your calculations, or if some bad luck comes along, you don't get wiped out. Here, check out this simple example. Let's say you've done your homework and you figure a company is really worth about $150 a share. But then Mr. Market has a total meltdown and offers to sell it to you for $75. Boom, that's $75 difference. That's your margin of safety. That's your protection. At the end of the day, this is it. This is the final test. If you buy a stock without a big margin of safety, you are basically just praying that the market will prove you right. You're guessing, you're betting, you're speculating. But if you insist on that margin of safety, you are protecting yourself from whatever crazy thing the market decides to do. You are investing. So that leaves us with one last thing to think about. The market is going to keep swinging from crazy greed to sheer terror. That's a guarantee. The chaos and the panic aren't a question of if, they're a question of when. So, the real question is, when Mr. Market shows up on your doorstep, a panicked mess, offering you fantastic businesses at ridiculously low prices, will you be ready? Will you have the courage and the framework to see the bargain and act on it? That's the question Graham leaves for all of us.